Hey gang, it's Friday, July 26th. We're at the end of the month, last week of the month. Big news, it's Friday. Happy Friday, everyone. Now, GDP just came out. The quarterly gross domestic product, the biggest sign of whether economy is growing or not, it came out. And the expectations were 1.8% growth. We came out at 2.1%, which is beating expectations. Last quarter, we were at 3.1%, but we were expecting a slowdown this time. But here's the problem with this, okay? According to I'm going to give you the bigger picture so you can follow along with what I'm seeing and why I'm seeing it, okay? So, economy's growing better than expected, all right? Fed came out a few weeks ago and said they want to lower interest rates because they believe economy is slowing down. Based on that, the stock market rallied, okay? And bond prices rose and interest rates went down. All right? Because they wanted to lower rates, so that's priced into the market. And that's currently priced into the bond market. All right? Bonds have been making highs, interest rates have been going down based on what the Fed is saying, that the economy is slowing down. Now we have the GDP, and the GDP says that's not the case. And by the way, this is a side note, but the Fed was making this statement while the stock market was at a 52-week high. They usually make these statements when the market is at a 52-week low because it's a way to save the market. Because whenever the Fed says rates are going lower, we're going to lower rates, which is something they haven't done in over a decade now, the market rises. So the market rose. It was already at a 52-week high. It rose some more. Interest rates went down. Bonds rallied. And now, a few weeks later, maybe less than a few weeks later, I think it's like 10 days later, the rug is pulled from underneath everyone. Economy is expanding. So what does the bond market do today? It's moving lower. Now there's going to be second thoughts about whether or not the Fed is going to lower rates because there's evidence that the economy is growing. So if the economy is growing, what the hell does the Fed need to lower rate for? And especially with the stock market being at a 52-week high. Makes no sense to me, right? So based on what we're seeing, based on the current GDP, it's contradictory evidence to what the Fed is telling us. And what this is going to do is, it already this morning, right after the announcement came out, and I wanted to wait for the GDP report this morning before doing this video because it was so important and it's the biggest report in the quarter. So the bond market, the futures, started ticking lower and interest rates started moving higher. And when bonds start moving lower and interest rates start moving higher, that's weaker for the stock market. So in essence, the Fed put themselves into a corner. All right. If the GDP was weaker than expected, then the Fed would say, we told you so. But what are they going to do with this data now? Especially knowing that the bond market is already pricing into its value the fact that the Fed is going to lower rates. So here's what I'm expecting. I'm expecting lower bond prices and I'm expecting lower stock prices as a result of the GDP. So why? Because the stock market has been artificially pumped up due to the Fed saying we're going to lower rates. And that may not happen now. So now we're looking for a little pullback based on that. Now, yesterday I explained to you market sentiment, market momentum, market internals were all pointing to a little downside, all right? And I think we're going to start seeing it now because the Fed has a harder case for lowering rates now because the economy is expanding. You don't lower rates when the economy is expanding. It makes no sense. So I wanted to give you this dynamic. You may want to watch this video a few times because there's several things happening here. There's interest rates going up and down. And remember, interest rates and bonds are inverse. So when bonds go up, interest rates go down. Interest rates went lower in anticipation that the Fed was going to lower rates. And now the GDP is the pink elephant in the room. All right, folks, you have a wonderful weekend. Expect a little softness from the stock market. And I hate to say I told you so, but I've been expecting it all week due to internals, the percentage of stocks trading above the 50-day moving average, and the put to call ratio yesterday, which was the highest call buying in a year. And that's telling me it's time for this market to pull back a little bit. Am I expecting a bearish run? No, not at all. Just to pull back to the 200-day moving average, maybe not even that, maybe the 50-day moving average. Talk to you guys soon.